InFi, episode 48.
Well, I would disagree with you could just invest in fractional real estate. Yes, you can, but it's not liquid. There's no secondary market for it. And then there's no derivative market. There's no DeFi market for it. And I'll explain what DeFi is. DeFi is where you can stake your security token tied to real estate and borrow against it like a margin account. Or if you're a developer, you can collateralize those security tokens and borrow against that, so you don't need lenders. There's no way you could do that with fractional. There's no such thing.
Welcome to InFi, the future of finance, hosted by American economist and author Dr. Robert Murphy. Each week, tune in for dynamic discussions with business pioneers about emerging trends in finance, life insurance, asset management, technology, and more. Now, let's talk the future of finance.
Hey everybody, welcome back to the InFi podcast. Today I'm going to be speaking with Mark Fidelman, who is the founder of SmartBlocks.Agency, a leading tokenization agency specializing in real-world asset tokenization for assets above $5 million. With over 2 decades of experience in technology sales, marketing, and customer experience, Mark has worked with organizations like NFT leader Wax.io and has been a prominent voice in the crypto and blockchain space. Among his accolades, I'll just mention one here. He was in 2017 named a top 20 influencer of CMOs by Forbes magazine. He's been named a top 25 social media keynote speaker by Inc. magazine and a Huffington Post top 50 most social CEO. So at Infineo, we often do Twitter, or X as the kids call it nowadays, Spaces. And we had Mark on recently, and he just did such a good job of explaining from first principles the concepts and then the rationale and business justification for real-world asset tokenization, taking conventional assets and putting them on the blockchain, that I just, I said to our people, hey, we got to get him on the podcast. And Mark graciously agreed. So that's what we're mostly focusing on in this conversation. So, here at Infineo, as you well know, we're putting life insurance on the blockchain, and I encounter resistance, not just from technophobes, people who just think, oh yeah, that's not safe, or I don't know, that's just so weird. You can just do it the conventional way. But also from fans of Bitcoin who think, no, the only thing blockchain is really good for is Bitcoin, right? And Mark does a great job of explaining why that is a short-sighted view. So that's the main thing we're going to do this episode. Let me just say as a disclaimer, I say this periodically, here at the InFi podcast, we're not giving investment advice, right? So if I have somebody on who's with a company, we're not telling you, hey, go ahead and invest in this person's company or use their product or whatever, but it's just we find interesting people. And then, of course, a natural thing to ask is, hey, tell us about your business. Okay, so if I'm friendly with Mark and whatever, that's obviously the context in which that's happening. Do your own research before you make any decisions about what you do with your own business. So with that introduction, here is my discussion with Mark Fidelman. Mark, welcome to the InFi podcast.
Well, thanks for having me, Bob.
Well, as I would have explained in the pre-recorded intro, we had you on a Twitter, or as some call it, X space, and you were so good that I said, we got to get this guy on the podcast. So here you are, making an elegant case for tokenization and so forth and things like that. So that's what I want you here. But before we dive into some of those more open-ended questions, can you just give the listeners a bit of your background as to, how'd you get into this area?
Yeah, I mean, to make a long story short, I started in crypto about 7 years ago, did a bunch of ICOs, and then soon discovered that there's too many hackers, there's too many fraudsters, there's all this bad stuff around all the good stuff, the top 10 tokens, for example, and some of the coins. These are game-changing projects, but there's too much crap around it. So I decided to pursue the tokenization route because I think we're going to be all going to be regulated at some point. Maybe not Bitcoin, maybe not some of the other, maybe it's not Ethereum either. But most of these things should be regulated in some way to protect some of the investors. So I went to the securities route, the tokenization route. And for me, it's a better fit. Everything is secure. It's safe. No one's going to steal your security tokens. It's nearly impossible. So I just enjoy this space a lot bit better. And for sure, it's the future. You can look at BlackRock. You can look at some of these other organizations. The traditional organizations are investing in something that's still early. That's a good sign.
Okay, great. So, and Mark, this is going to be elementary for you, but that partly, like I say, why I wanted to grab you and bring you over on the podcast is I could just tell you were very pedagogical, maybe is the word I want, where you're good at just explaining.
An evangelist?
Oh, that too, yes. So again, this is going to be real simple stuff, but I think we get into, as with any technical field where the people who are in it day in and day out get into a habit of throwing around jargon.
Yeah.
Maybe a newcomer doesn't quite. So right there, it seemed like you were making a sharp contrast between crypto and tokens or tokenization. Can you just explain what's the difference?
Yeah, I mean, the easiest explanation is one's a securities, one is not, but then you get into how you define that. So tokenization uses the same tools as crypto, and thank God, because crypto's created these amazing tools, but it does not come with regulation. So tokenization is a token secured by an asset, legally secured by an asset. So think of it as a share or a stock or something that's connected to a valuable or sometimes not valuable asset, but it's connected to an asset. And that's what we call tokenization or security tokens or real world assets. You see all these terms being thrown about. They all kind of mean the same thing.
Okay, so the way you use the terminology, token and security token, it's not that a security token is a special type of token. That's just sort of redundant. It's just saying a token necessarily is a security, the way you're using it.
How technical is your audience?
There's a spectrum, I think.
Okay.
So
I'm going to appeal to the more technical side of the spectrum. The token for security tokens is typically issued using a different Ethereum standard, and you'll see a lot of other blockchains issue, instead of an ERC-20 token, it's an ERC-1400 token. All that means is we do additional security checks automatically on the wallet. So we do KYC, which is know your customer, and we do an AML, anti-money laundering check. And that's done automatically with an ERC-1400 token, which is still an Ethereum token. It's just a different, let's call it a contract, a smart contract that makes sure that you're trading with somebody that is known.
Okay, great. So let me now to flip back to the people from a more general audience member. Do you agree with the following, or are there nuances that you would add in? So something like Bitcoin, big picture, Bitcoin doesn't refer to something else. It's its own intrinsic thing. You control certain amounts of Satoshis and the finely divided units of it. And you have your private key and you have the ability to move Bitcoins from one address to another if you're the one who controls them. And that's its own thing. Whereas a security token, again, those other phrases you use like real world assets, it's like, yeah, you have the ability to move these things around, but the reason they're valuable is that they are somehow linked to other assets like real estate or stocks or bonds or whatever. And here at Infineo, life insurance. And so that's sort of like a thing pointing to something else in the tokenization realm, whereas Bitcoin is not a security because it's not a claim on something else. It's like a commodity in terms of how you would classify the thing. Is that roughly correct?
And that's exactly how the SEC and FINRA classify Bitcoin and security tokens, because they are attached to something valuable, are a security because there's an expectation of profit.
Okay, great. So now that we've gotten through that, can you maybe just speak a little bit more on, do you think, I know why you're saying you personally decided you want to get out of, there's more regulation, you just felt more comfortable. Is there more law and order, for lack of a better term, that's coming to even the genuinely just crypto space as well, do you think? Like are they learning their lessons and are going to, because some of the things where people were hoodwinked, like after the fact, it's like, yeah, how did you guys not know that wasn't really going to go so well? Or do you think that no, that's still pretty?
It's still pretty prevalent. You still see a lot of hacks. You still see some of these things happening because the crooks are getting even more clever. And since there's no checks and balances, there's no way of knowing who's taking your tokens, then this crime's going to exist for a while. And by the way, that doesn't happen with security tokens. I'd be happy to explain why, but it's a totally different situation.
Yes, because go ahead here. Let me play with all this stuff, Mark. I'm going to play like devil's advocate, kind of, sort of, on some of them, just to give you a foil to push back at. What if you encounter some sort of Bitcoin maxi kind of person, and they're like, "What are you talking about? If I got my private keys, nobody can steal my stuff. So what do you mean? How can a security token there? You got to rely on the integrity of the people issuing the token. What if I don't trust your company? I don't know who you guys are."
Well, first of all, there's all sorts of phishing attempts that even if you're securing your old your own Bitcoin, unless it's in a cold wallet blocked somewhere in someone's vault. You can be tricked into giving up Bitcoin. But with security tokens, you can't. And here's why. First of all, security tokens are tied to an asset. So let's say it's real estate. And the cap table of who owns that real estate is always kept by a central authority. This is anti-crypto, but so what? Where you can have crypto and security tokens, they're not mutually exclusive. And so if you have a cap table that says, here are the owners, and then somebody hacks my wallet and steals my security tokens, I just go back to the owner of the real estate and say, somebody just hacked me, cancel those and reissue mine. It's that simple. Our platform allows that too. So there's virtually no way you can lose your security tokens, assuming you act fairly fast, because in the future, and I'm contradicting myself, I understand this, in the future, they'll be able to flip out of those pretty fast themselves, but you still be able to unwind it. And because it won't trade with a wallet that's not been KYC'd and AML by some third party. It'll know who did it. Now, you might not be able to find them in Africa or India or China, but at least you'll know who it is, and at least you'll be able to unwind all of it if necessary.
Okay, great. And you sort of anticipate that. You said a moment ago that, hey, they're not mutually exclusive. So I take you to be, sort of hey, if you want to hold Bitcoin, go ahead, more power to you.
Absolutely.
But what you're saying is there's also this huge use case for blockchain technology or tokenized real world assets. So in your case, real estate, your specialty. And just because there's some centralization there that, yes, you have to trust, even if everyone's using Bitcoin as the money, you're still going to go to the grocery store and trust they're not putting poisonous food out for you. So it's not that Bitcoin means no trust is necessary anywhere. And so, yeah, if there's a company that's reputable and people like their security tokens, they can go there. And one of the benefits of that model is, even if you get hacked or whatever, then you can just restore your stuff. Just like somebody breaks into your online checking and transfers money out of your checking account, you just call the bank and say, that wasn't me. That wasn't my purchase.
Right. That's exactly right. Yeah, you could do that. And these tokens have a legal representation of a share of that real estate. So even if you have a crooked third party that's issuing these tokens, you still are recorded on the title of that property, assuming they haven't faked that somehow. I mean, I can't stop that from happening. That happens anyways in the traditional models. But we do a very, very robust job of ensuring that the entity, it's an SPV that owns the real estate, has been recorded with the right authorities. So assuming you're working with somebody like us that does those checks, it's one of the safest investments in the world. And by the way, anywhere in the world could invest in U.S. real estate this way, whereas now, good luck trying to set that up.
Okay, and your company is SmartBlocks. Do you want to just explain for a minute what exactly it is you guys do? We've been alluding to it.
Yeah, I won't give a commercial here, but we do tokenization of real estate. So people list real estate from around the world, and then we allow people to invest in that real estate through tokens for as low as $50.
Okay, great. So let me ask you, again, this is softball things that you're used to, but this is just for people to get their heads wrapped around it. I imagine some people, particularly if they're older, are going to say, this is nothing new. You can, invest in fractional claims on a pool of real estate assets anyway. So what is this? How is blockchain doing anything here?
Well, I would disagree with you could just invest in fractional real estate. Yes, you can, but it's not liquid. There's no secondary market for it. And then there's no derivative market. There's no DeFi market for it. And I'll explain what DeFi is. DeFi is where you can stake your security token tied to real estate and borrow against it like a margin account. Or if you're a developer, you can collateralize those security tokens and borrow against that, so you don't need lenders. There's no way you could do that with fractional. There's no such thing. Additionally, anyone can buy your piece of real estate in 4 clicks because it's on the blockchain. You imagine going through a legal process for $50 to buy real estate in the US through more of a fractional model. I mean, that would be a nightmare. You wouldn't want to do it. So the only way you can do it is through the blockchain because of the efficiencies that you get using blockchain.
Okay, can you elaborate a bit on, you said even the developers can do something. Can you expand on that?
Yeah, so the developers issue property tokens. They're security tokens. I call them property tokens because they're tied to property. And so let's say you have $1 million property. Let's keep it simple. Millions on the low side of what you would want to do. But let's say it's $1 million. and you have $1 million worth of property tokens. Well, you could take those property tokens to a DeFi market, which is decentralized finance. You can collateralize them, meaning you're using these tokens as collateral, and then you get bids from around the world to lend you money against those. So let's say the real estate rates here in the United States are 8%. Well, maybe in China or in Japan, they're 2%. So why would you want to invest in or get a loan in the US when you can get it from another country at a much lower amount? You wouldn't. And so that's the beauty of having it on the blockchain where it's accessible to anyone in the world instantly.
Okay, so just as an economist, I'm saying that one way of viewing what you're doing here is just reducing transaction costs, that there's capital owners around the world, they'd like to get access to certain types of opportunities, and this is just making it a lot easier for the lender and the borrower to find each other.
Yeah, globally. I mean, you couldn't get a loan from Japan on US real estate. How would you do that from a Japanese bank? That would be very difficult. Maybe you could do it if you've got strong connections, but you could do it in like 15 minutes using DeFi. Now, these markets aren't robust yet for property tokens, but they're extremely robust. All the crypto people watching know this. Instantly, you could be collateralizing and borrowing against your crypto tokens. And we're right around the corner from this happening with property tokens. So why in the heck would I get a mortgage here in the US if I can get a lower rate somewhere else in the world? You wouldn't. You'd take advantage of the lower rates in other parts of the world.
Okay, great. Can you speak, again, just thinking from somebody who's new to this, I imagine another objection would come and say, okay, yeah, you guys can do all your funny stuff on the computer and whatever, but at the end of the day, it's got to be the local registrar of deeds or title says who owns what. And that's kind of decisive, isn't it? That if someone calls the cops on me and says this is a squatter, like the local government has to agree who owns that property. And so you guys have got it all sorted out too?
Yeah, what you do is you set up an SPV, almost in every country, or an LLC. It can be different. But the point is you have a special purpose vehicle that only owns the real estate. The investors are actually investing in that. But that SPV is the only thing on title. So that special purpose vehicle controls the real estate. We also control the monies, rents collected, things paid out, monies to the developer. So there's even another layer of protection for our investors and frankly for our developers so they don't get in regulatory trouble. So that's how it's done. It's very safe, very secure, probably way more secure than most traditional real estate developers have it set up.
Okay. And can you give people a sense of, is this like something that one distant day in the future might work, or this is up and running and this is going already?
Oh, yeah.
Can you give us an idea, like whatever stats you have handy at your fingertips? Just an idea.
There'll be, by 2028, they're saying there'll be about 16 billion tokenized in real estate. And by 2030, there'll be 8 trillion in everything else, because you could tokenize literally anything of value. So those are the relevant stats that I throw out there, but frankly, nobody really knows. I see the trends. I have a newsletter that follows the trends, and so far it's looking pretty good. I think if there's turnover with the SEC and FINRA, and they actually put clear regulations as to this is tokenization, this is how you do it, we're going to see it hockey stick way faster than that, because you'd be foolish not to do it. But now the excuses we get from the big developers, not the smaller ones, are, well, we just don't want the SEC and FINRA looking around because they're pains in the asses and they always find something wrong and they fine us left and right. Imagine us getting into tokenization and we just one misstep and they're coming after us. So that's the big thing holding us back from the bigger developers in the US. The FINRA and SEC, they don't really mess around with smaller developers. There's no money in it for them.
Okay, let me just go through some things here that I grabbed from your website. Well, one, you've touched on a little bit, but you say, we believe that DeFi is the future. So can you just elaborate on that a bit more?
Yeah, I'm going to try and keep it for the layman. I'll try.
Okay.
So all DeFi is for real estate is a borrowing and lending platform. And that allows you to stake or collateralize your property tokens. I'm only talking real estate. All you crypto guys, I know there's way more. Okay. I'm just talking the property tokens. So stake and collateralize your property tokens, and that allows you to borrow against them instantly in most cases. Also, what's coming is derivatives. So you'll have people that gather up all of these real estate property tokens and then sell that off almost like a derivative mutual fund that's just to get cash flow or to get returns. And we all know the derivatives, what happened in 2008 with that derivative market kind of crashed everything around it, except for these are, think of, the blockchain keeps a record of every single transaction, right? So this is like a Carfax of transactions for all of these derivatives in these packages. So you can easily analyze if these are real performing assets, or is it the BS that Wall Street put out in 2005 to 2008, which crashed the market? So that's why I always say it's going to be safer, it's going to be better, and it's going to be more transparent. And you and your grandmother are going to be able to analyze these things. So that's also coming, and that's also going to be attached to DeFi.
Okay, yeah, you anticipated what that was going to be one of my other layman questions. It was my understanding after that stuff imploded, I went around and I did, just as an economist that is very favorable to the free market, and I was trying to figure out why'd that happen.
That's a scam. I can tell you real quickly why it happened, because the rating agencies were rating things AAA when they were like B-. And so Wall Street was buying these things as AAA, which they weren't. And Wall Street, you know how difficult it is to unwind a bunch of derivatives that have different underwriting standards and have no payment history that somebody's going to go and look at? No way. But with blockchain, you could do it with a computer program. AI would easily analyze it in seconds.
So, well, yeah, we're coming to, because that's what happened. I was talking to some of the people at, I forget who I was talking to. It was a major investment bank for sure. And the guy was like, yeah, it wasn't me, he said, but it was like we had physics PhDs down the hall looking at these things. And he's like, you're saying, Mark, that it was like 1,000 different pieces of mortgages all thrown in there, and they had different like conditions under which for certain tranches these would hit and these would. And he said, like, nobody outside could even tell what the thing was. And then they would, apply the Black-Scholes formula or whatever, and then say, yep, AAA. And he said also, interestingly, just as a side, one of the intellectual mistakes they made is when they were modeling it, they assumed all real estate was local. And so they said, oh, the chance of the Phoenix market and the Miami market going down 10% at the same time is, like those were independent statistical events in their model. And so therefore it was like a 1 in 1,000, year event of what actually happened. So that was part of it. Okay. You've got another interesting point. You say what you guys are doing is giving a voice to the disenfranchised and unbanked. So what do you mean by that?
There's quite a few unbanked people around the world that have no way of investing in anything. And I differentiate between saving and investing. Investing to me is very active. Like you find something to invest in, you make a risk, depending on the risk, you make a risk investment in something and hoping that it pays off. With savings, you're just kind of hoarding money, and maybe the bank's giving you a few points of interest. And that to me is a losing formula because of inflation, of course. So if you're unbanked, how do you move money into these investment vehicles? How do you get it out of your country? There's a lot of these people have a tough time getting it out of their country. And then if you're getting out of the country, then you have to set up an account in that country. So when you have something like SmartBlocks, all you need to do is wire it into us, or use crypto. You could use crypto to buy some of these properties for as low as $50. So that's opening up the door to true investing from around the world, not just your local country, but from around the world into real estate. And then even beyond that, even if you're in the US, if you were like me in my 20s, I couldn't afford real estate back then. I can't imagine people in their 20s now trying to afford real estate. At least you could build up a portfolio of different real estate that in 2, 5, 10 years is going to pay off huge. And I can go through a case study that would demonstrate why investing $1,000 a month in property tokens over 10 years will give you a $20,000 a month income.
Yeah, I mean, if it's something you can do
real quick.
Yeah, sure. Go ahead.
So if you look at the average return of commercial real estate as long as you reinvest all of the capital appreciation as well as the dividends back into security tokens, so $1,000 a month plus you reinvest everything that you get, our analysis shows between 9 and 10 years, you'll have a $20,000 a month passive income just from owning these security tokens. True passive, you're not involved in managing the properties at all. Those are everybody else. So that's incredible. I wish I would have had something like that when I was 20. I know $1,000 a month is a lot for some people, but if you can hack it and you can go 10 years, that's a pretty good passive income. You can start that at any time.
Right. And you're kind of going back to the earlier point about what these things allow you to do is when you were your age, you couldn't have actually done that in practice because no one's letting you just put in $1,000, right? Here and there, dribbling it in. It's like, no, we got a certain amount. You got to put it in. You just bought one property where, in your town or something, or even if it was online and you found it, somewhere in Las Vegas, then, if that one market goes down, you're in trouble. Whereas here, you can kind of spread it around. And so you're just investing in real estate as an asset class.
Yeah, plus you'd have to put 20% down, maybe 10 in your local market. So whatever the pricing is in your local market, like a Vegas, what's the average house there? $1 million? You still have to put $100,000 down. Not many people have that, especially now.
Right. Okay, very good. Well, let me walk you through here. You've got a nice little 5-point thing on your website here, the benefits of fractionalization. So I'll make it easy on you. I'll read to you each of the headers for the 5 points in case you haven't looked at that recently. Yeah. And then if you could just elaborate on these, because that's what. So again, this is for folks at home, the benefits of fractionalization in terms of someone investing in real estate. So you got number one, access to global capital. Some of these are going to be a bit redundant, but I'll go ahead and just let you riff on it if you want.
Hopefully I've covered them, but let's keep going.
So access to global capital. 2, increase liquidity. So can you just elaborate on that, just so people understand what you mean by that?
Yeah. So if you invest in commercial or residential real estate, you cannot get out of that investment until the property's sold. Maybe you find a broker that's going to take 25% and sells it to somebody else, the shares. But with tokenization, you just sell it in an exchange and you're out just like that.
And it's sort of a self-fulfilling prophecy is not the right word, but the fact, part of the reason it would be hard for you to unload your shares right now in a more conventional arrangement is because the potential buyer knows that then they're going to have the illiquidity. Whereas if everybody knows I can just go to this exchange via SmartBlocks or whoever and get rid of it, then that makes more people willing to take it. And so that solves the problem of not finding someone who wants it.
And it makes the property 10% more valuable, like you said. But where are you going to find somebody to buy a piece of commercial real estate that you own? And let's say you've got 10 million invested, because that's probably the minimum for most of these as a limited partner. So $10 million, you got to find another $10 million buyer for this commercial piece of real estate. Good luck. I mean, there's very few of these transactions that happen in a traditional market. They're just not there's just not a lot of them. And then there's so many other opportunities for these people to jump into without a broker payment it rarely happens. I would say 0.001 of the time you are able to unload your shares in some of these real estate projects in a traditional model. In a tokenized model, it's going to be very prevalent, like trading stocks.
Okay, number 3 you've got down is cost effective. So, I mean, you did say that, but can you just elaborate on that?
Yeah, I mean, first of all, anyone that's bought real estate knows the pain of going through that legal process to buy the real estate. With us, it's 4 clicks. I could stop there, but I'm going to continue because in 5 years, and Dubai already does this, everything will be on chain. Dubai doesn't do it on chain yet, but they have this system where they don't have title insurance. Title insurance is kind of unique to the United States. Everything will be on the blockchain, so you don't have to pay title insurance, and everyone knows how expensive that is. And then escrow fees. We'll have escrow for a while, but eventually everything will be part of a smart contract that dictates, here's how this thing's going to be purchased, here's what's going to happen with the funds, and here's what will be recorded. We'll need escrow for a while until the local authorities all get together and say, okay, we're going to allow these things to happen digitally, and this is how we're going to do it. We're not there yet. Might not even be 5 years, because getting a bunch of bureaucracies to cooperate is hard, and then getting them to go blockchain is even harder, until they realize it's super easy for them to tax and take money from these transactions. If they just realize that, that's going to open the floodgates to them. But they don't even realize that yet.
Yeah. Okay. Number 4 is enhanced security. You did touch on that, but do you want to just take another crack at that?
Yeah. I mean, it's nearly impossible to hack a security token. So like having shares of real estate in a traditional sense, where you've signed a piece of paper that says, I've got this, and so what if a thief comes in your house and steals it? You just go back to the developer and say, reissue these, cancel that one. It's that easy.
Yep. Okay. And then 5th, you've got streamlined compliance.
So streamlined compliance is coming. Some countries already have it. So the checks and balances will be on the blockchain, like an ERC 1400 checks to see that you're not a money launderer and that we know who you are. You're not some random bot that is buying real estate. So that's the first step. The second step will be, hey, is this transaction legal for this country? Because right now you've got 50 different regulations that are out there, and some people manually check to make sure that it's legal in that jurisdiction. You really don't have to. It depends on where you tokenize the property is where the jurisdiction is. Although our SEC and FINRA will say, hey, if you're selling to a U.S. investor, you must abide by our laws. Even though they don't have, SEC FINRA doesn't have jurisdiction, they'll penalize them some other way. I'm not going to get into the ways they do it. So, we follow the U.S. laws too, even if the jurisdiction is in El Salvador.
Okay, great. And again, I'm glad that you are emphasizing that, because that's something where I think a lot of people would have thought it would be the other way around. That, I'm sure there's pros and cons, but surely this is an extra layer of complexity, and so the compliance must be harder. But you're saying certainly in the long run, this is going to just make everything a lot easier.
Way easier, because you got to hire attorneys to do all this stuff, and most of these attorneys like to drag these things out and charge you more than they should.
Now, something that came up, I think, in the Twitter space that we did, am I right in saying that you and your, I don't know if competitor is the right word, but other platforms in this arena, you should like host each other's tokens?
Yeah.
You know what I'm referring to? Can you just elaborate on that?
Yeah. At this point, because we've done a deal where we're going to host each other's property tokens, it's just exposing you to more people. And that's the primary issuance. The secondary, we anticipate our competitors and I to get together and really create a robust secondary market that we either all have a seat on, is what I would prefer, or if we all have secondary markets, they're all talking to each other and communicating with one another. And so we don't have what they have in crypto, which are these silos where, and some people don't care, but you can arbitrage across silos, and you get a lot of gamesmanship in crypto that's can work against you or work for you, depending on what side of the game you're on. But we're hoping to create a kind of a different ecosystem that's unheard of. Imagine if NASDAQ and New York Stock Exchange, the London Stock Exchange, they all were trading the same token at the same time, at the same price. That's literally what I'm advocating. We'll see if it happens.
Well, yeah, and I think, I'm sorry if this is all redundant for you, Mark, but I think I brought this up during the spaces, that it's just interesting because it's dovetailing. I've been doing some research like on banking in Scotland back in the day, and when it was so-called free banking period, where the banks themselves would issue paper notes that were claims on gold or silver, and those would trade at different amounts. And the big banks, after a while, they just started accepting each other's notes at par because they realized this is like, you don't want somebody in the community, if they have my particular bank's notes and they go into their local merchant and they try to pay for something with the note instead of having, coins, that the merchant's like, well, my bank doesn't take that bank. So you got to, and they just realize we're splintering the market. If we all accept each other's notes, then the community likes our notes, and we want people to think, no, these notes are as good as the actual coins. And they, the banks all realized that was in their interest. And if one bank got reckless and started printing like crazy, it would pretty soon, the chickens would come home to roost, because the other banks would get more of their notes than vice versa. They'd present it at the end of the week or whatever. Say, okay, give us the coins out of your vaults. And then they would say, we can't. So it was kind of like a self-policing internal system. That's kind of a neat thing. So that's when I heard that feature about what your vision was, I thought, because right now, clearly the big hurdle for you is to get the public to think that, this tokenization route is as good as, and you would argue even more convenient than having the more traditional amount or approach.
Yeah, where you couldn't sell anything. You'd have to wait until the property was sold. Yeah.
Yeah. So that I guess, yeah, to say that, yeah, why now, even though there's a sense in which some people are your competitors, yet you all do better if you can get the public to want to do it. And how do you promote that? If you're all accepting each other's tokens on each other's exchanges, that's how you get it off.
And also, everyone's got more liquidity, and the best marketing wins because the fee takes place on your platform, so you get the fee, not anyone else. So everyone wins, and it's still competitive. It's not a monopoly situation. You're just listing everybody else's tokens, and the best marketing, the best competitor or exchange gets most of the fees, but also provides liquidity for the rest of the market, which raises, the tide rises all boats. So that's what I'd like to see. We'll see if it happens.
Okay. Mark, this is me making a comment to you on the side. Our Zoom thing is, the subscription's all messed up. We got 2 minutes and 30 seconds left. And I think, why don't I just ask you one final question and I'll wrap it up rather than us doing another meeting.
Let's do it.
I'll make a note. So sorry about that. Okay, well, that's fascinating stuff. Maybe as a final question here, Mark, can you just give the listeners, just paint the picture as to how rapidly do you think this market's going to change? And, is tokenization just going to be as obvious as email in the near future?
Great question, Bob. There's one caveat. I'm assuming that the current SEC, FINRA, because they're losing almost everything in court nowadays, will be forced to provide clear regulations for the tokenization market. Now, if that doesn't happen, all this goes out the door.
Sure.
So I say within 5 years, this is a top choice for anyone that needs to raise money or invest money in real estate. And one of the top choices for everything else that's tokenized, like art, exotic cars, whatever it is that you're tokenized. There's royalties. You can tokenize anything, patents. One of the top choices. Real estate really needs it, and that's why I'm in real estate. And then within 10 years, everything that has a financial transaction will be on a blockchain. I can't choose which blockchain. I'm certainly hoping it's not a government blockchain, but it'll be on a blockchain, visible and transparent to everyone, which stops 99% of the scams that are out there, because you can trace the history of it. You can see what kind of track record developers have. You can see what kind of track record investors have. Everything's out there. I liken it to like Yelp, where you can go and see everyone's rating as to how they perform as a restaurant and a customer and all the rest of that stuff. So this is all good for us. No longer will you have a Wall Street kind of monopoly on the financial markets. You'll be able to participate in it on both sides of the fence, investor or developer or seller. And that is a good thing for us.
Okay, well, that's a great note to end on. My guest has been Mark Fidelman of SmartBlocks. Mark, thanks so much for your time and your insights.
My pleasure.
Thanks, everybody, for tuning in. See you next time.
This concludes another episode of InFi, the Future of Finance, with Dr. Robert Murphy. The information provided is for educational purposes and does not constitute financial advice. Consult with qualified professionals before making any financial or investment decisions. For more information on the host and for previous episodes, visit InFi, thefutureoffinance.io. Thanks for listening.